So what's the state of the net lease market today? And in particular, what is happening with the drugstore pharmacy sector? The headlines would make you believe one thing, when in reality, devil's in the details, and it is not all doom and gloom. In fact, in many instances, the bankruptcy by Rite Aid and the current environment could be a positive in the long run for those investors looking for quality net lease retail investments. Let's talk about what's really happening. One of the issues that the net lease sector is facing is the volatility in the capital markets, which we have been experiencing for the last 12 plus months, where we have a rising interest rate environment and a decreasing lending pool. As a result, combined with the fact that we have an imbalance between supply and demand of product to buyers and a dislocation between valuation, you're seeing a buildup in inventory and a significant slowdown in transactions. As a result of the decrease in multifamily sales, where the majority of investors, if they do not stay in multifamily, are going to net lease retail, that fall off in investor has impacted sellers, developers, and pricing. Combine that with the rise in interest rates and the dislocation between private investor return expectations and seller needs, we're at a stalemate. The market remains frozen in that regard. So let's talk specifically about the drugstore net lease market, one of the more vibrant retailer sections of net lease investment. You really have three major players: Walgreens, CVS, and Rite Aid. The headlines obviously don't look good. With Rite Aid's recent filing of Chapter 11 bankruptcy, one would perceive that the industry is in trouble. However, don't let the headlines fool you. Rite Aid's bankruptcy has been anticipated for many years, and it should be a net positive for them, as well as for the industry, for both CVS and Walgreens as well, and from a real estate perspective. Now, historically, Walgreens and CVS traded at a premium relative to Rite Aid, based upon the quality of the business, as well as the real estate in those markets that they operate. All three stores have been going through a physical store rationalization over the last 3 to 5 years for varying reasons. That does not mean that they're moving away from their physical store commitment. In fact, it's doubling down. It's reinforcing the physical demand as it moves to health and wellness and other business lines, in addition to the traditional pharmacy and convenience food offerings. So let's summarize. The headlines aren't always telling the full story. Net lease retail investment sales still is a strong, viable investment opportunity. Are there headwinds? Sure. That does not mean that one strays away from the opportunities that are existing in the sector. There's a variety of opportunities and issues. And don't forget, net lease retail investments provides more than just a return. There's depreciation, there's taxes, and there's long-term benefits to the sector, which is only getting stronger as physical retail remains the number one choice for where consumers want to get their goods.